Good morning, it's Jeff Christian, CPM Group, about 10 o'clock on Wednesday, the 17th of February, coming to you from New York. We have a lot to cover on. Gold prices have been weak, silver prices have been strong, platinum prices have been stronger. And I think there's a lot of things to talk about that are actually happening, and there are a lot of things that to talk about probably that aren't happening. Those of you who know me know that I really don't like to waste time and be distracted by all of the nonsense that circulates in precious metals markets, but you have to be aware that it's there. And I often say that one of the downsides of my job is that I have to read all this garbage, and I have to be ready to explain to our clients why they don't need to read it and don't need to worry about it. I want to start with a broad topic. I'd love to talk at some point when we have the time about the commodities supercycle. When that phrase was coined around 2005 or whenever, I said, this is marketing hype. The reason why commodity prices were rising from 2002 to 2008, 9, 10, 11, depending on which commodity, had to do with basic economics. And it was economics 101. If you knew supply demand analysis and you did your work properly, you understood why oil and commodities and grains and coffee prices and metals were rising. It was basic economics. And the concept of a commodities supercycle was a carnival barker's hype. And you know what? It still is. We got over that after commodity prices moved into a cyclical downward move for 3 to 5 years, and now it's come back. It's very easy, I think, to discriminate good from bad information in the commodities markets. If someone's talking about basic economics, they're basically an economist, and they're an analyst, and they're looking at the markets and they're studying the markets. If someone comes at you with the commodities supercycle, they're a marketing person. And it's carnival barker. Go away from it. You see a lot of strange information floating around the markets, especially silver right now, but to a lesser extent, platinum and gold too. Let's start with gold. Gold prices have been falling. Now, we've been saying for several weeks that the potential, if you look at gold prices, they spiked down sharply at the end of November, and then they rose back over the course of December. Then they hit a peak. They spiked up in January 5th, 6th, and they came back off $145 in 2 days. They rose back, but they didn't rise back as far as they had been at the end of December. And that was a negative sign for short-term price moves. We've been saying for some time that we thought that the gold price would be lower in the second and third quarters of this year, and that the overall increase in gold prices this year, which we expect to be about 6% on an annual average basis, would be quite less than the 37% that we saw on an annual average basis in 2020. 2020, we were coming off of a base. We were at the beginning of a cyclical upward move in gold prices, and we came out of the box strong. We also had the pandemic, the economic recession, and the political dysfunctionality around the world and in the United States, contributing to investors wanting to buy a lot of gold. And they did, 3 times as much as they had in 2018 or 2019 on an annual average basis for physical gold. We've been saying for some time that we thought 2021, 2022 might see slower growth in the upside and some price weakness as the world economy recovers, the pandemic comes under control, and maybe we move to a slightly less dysfunctional political system in the United States and on a global basis. But we've been saying all of those big problems are still there, and they're going to have to be dealt with at some point. It's probably just not in 2021, 2022. So we've been saying for a few weeks that we thought that the gold price had the potential to spike down the way it did in late November and the way it did in January 6th and 7th, which was a $145 move, and that you could see the price hit 1720 or 1700 in the course of February and March. And then you go into the seasonal weakness of the second and third quarters. Prices may as the economy recovers and the vaccinations spread, maybe you see the prices move sideways with some downwards move, but some upward move. That's what we're seeing. And so today the price has gotten down to 1778 as I'm talking to you. Our expectation is that, you know, you've got a moving train. You don't want to jump in front of a moving train. This train is moving lower. You're seeing institutional investors unwind their long positions and increase their short positions on the COMEX. You're seeing a lot of issues, stronger dollar, strong retail sales, signs of economic recovery in the United States and China, Japan, parts of Europe. You're seeing a lot of things that are not necessarily stimulative of investment demand for gold on a short-term basis, and those things are contributing to the weakness. And you know, we would expect to see the gold price continue to decline. You're also having some very large institutional investors getting out of gold. I would advise them not to do that. I would say keep your gold, buy some puts against it. That way you're still long gold, but you can make a lot of money on the downside with your puts, unwind them, sell them back. When the price has fallen, you're still long gold, but you've reduced your net effective acquisition price. But I don't run those funds. So we're seeing weakness in gold, investment demand reflected in weakness in prices. In silver, you're seeing the opposite. And some of those institutions that are saying that they're selling their gold are buying their silver. And the silver price has risen. We had this funky little thing earlier in February where some people tried to squeeze the market. It didn't work out because they didn't understand what they were doing. They didn't understand the nature of the silver market. There's still a lot of weird things being said about silver. Oh, there's a squeeze in London. Well, no, there's not a squeeze in London. But when you had this attempted squeeze, I'm not quite sure what the numbers were, but I think you had about 58 million ounces of SLV shares bought in a 2-day period of time, which means creating those shares, delivering 58 million ounces of silver into the SLV management system. And then in the following 2 days, you had about 27 million ounces, half of that liquidated. Now, there's no depository in the world that can put 58 million ounces of silver into it in 2 days and take half of it out in 2 days. And that doesn't have to happen if you understand how the system's working. What has to happen is depository receipts have to be delivered to the SLV's managers. So you don't have to physically move that metal. Also, you've got about 1.1 billion ounces of silver in London inventories at present. It's down from its record earlier in 2020, but it's still at historically very high levels. And of that billion ounces of silver, about 450 million ounces of it is unallocated. It's available. So the idea that you had to find 58 million ounces of silver in London, not a problem. The idea that you have to process all of those trades in 2 days, that's an issue that causes friction in the market. It's not a squeeze, it's friction. And then when you have to unwind half of them in the next 2 days, it's friction. So you can have friction in that market. It's very funny. One of the crazy things I saw was, oh my God, the SLV allows for the manager to have allocated metal, and you can have unallocated metal. And the rules at the SLV is that on any given day, the SLV managers should have no more than 1,001 ounces of unallocated metal. That's one silver bar, one 1,000-ounce silver bar. So in other words, every day the managers should have fully allocated metal equal to the shares that they have. There is a provision that says in a problem, if there's a problem sourcing that much allocated metal that quickly, the manager can have unallocated metal for a period of time while it resolves that. And one of the things that you've seen is people say, well, you know, it's funny because they've never actually reported the division between allocated and unallocated metal. That's because it hasn't happened before. Oh, okay, it's only been 14 years. since we created the SLV. So yeah, but it hasn't happened, and that's why it hasn't been reported. There's a lot of crazy things going around being said about silver that are simply not true. What's true is that investment demand was triple last year what it had been in the previous years. We had more than 100 million ounces of silver bought by investors. It wasn't 300 million ounces. The SLV and other ETFs rose more than 300 million ounces. But as we've said in the past, a big portion of that, and now we're thinking it might have been as much as 200 million ounces, was actually SLV shares bought by bullion banks who were disgorging their physical metal because senior management was telling them to reduce their exposure to gold and silver and get out of the business or cut back severely. So you did have about 100 million ounces of silver investment demand last year, triple what it had been in the previous 2 years on an annual inflow basis. And you still have strong demand, and it's getting bigger. And frankly, one of the things that we warned about in the late 90s, early aughts, when we were talking about creating precious metals allocated ETFs, was that these things are too easy to buy and sell, and they can cause a lot of problems compared to buying and selling physical metal. And that's one of the things that you saw, 58 million ounces of silver SLV bought in 2 days, 28 million ounces sold, and now you have other people coming in, and it's done with a click of a button so that the market has to run to keep up with those computerized orders. And it's friction. It's not a squeeze, it's not a shortage of metal. Record levels of silver in London, in New York, and in China, and in other places. It's not a shortage, it's not a squeeze, it's friction. It's the mechanics of the market struggling to keep up with the fact that a lot of people have discovered silver. Platinum also has risen, and it's risen more sharply than we had expected. We're a little bit surprised about that, but we're not really surprised about it. And there's a lot of weird misinformation going around. There's a lot of concerns that the South African platinum industry might have to lock down again because of the coronavirus there. That's not clear that that's going to happen, but there's concerns that it could happen, and people are building inventories. There is something we've talked about for years, which is the shift away from palladium intense catalysts to platinum intense catalysts in the auto industry, both for diesel catalysts and for petroleum or petrol or gasoline powered vehicles. You're seeing that shift because of the price differential between palladium and platinum and the relative availability of readily sellable inventories in those metals. In both of those metals, there's a tremendous amount of metal in inventories, refined inventories held by investors, some through ETFs, some through physical metal, producers, refiners, fabricators. There's a lot of inventories out there, but the inventory holders don't necessarily want to sell, especially because palladium keeps rising. They don't want to sell the palladium until they see it falling. And platinum, because it has fallen and it can't get up. It's starting to rise now, but it was $1,600, $1,800 an ounce a decade ago. In 2014, 2012, 2013, 2014, it started to fall. It broke below $1,600. It broke below $1,400. It went down to $900, and it has been moving sideways around $1,000 an ounce for several years. It's starting to move out of that. It broke above $1,100 earlier this year. Then it broke above $1,200. It made a run over $1,300 yesterday. It's come back off. It's below $1,300. There's a tremendous amount of bullishness about something that has been coming for years, but now people are hyping it more. It's the carnival barkers again. Probably. I mean, it's a real trend that's being blown up in marketing hype for platinum. There's also a lot of hype about fuel cells, which just don't use that much platinum and probably won't use that much platinum going forward. But there's a lot of hype about how platinum is going to be used in auto catalysts, and it's going to be used in fuel cells, And there's even hype about it being used in electric vehicles, which we're sorting through right now. So there's a lot of marketing power trying to convince investors to get bullish on platinum. And frankly, we're bullish on platinum. We think the price is going to rise over the next 5 years, 3 to 5 years. But I think that it's a little bit ahead of itself right now, but that's because we're into a new commodity super cycle and people are believing that. One of the things I've learned is never underestimate the power of the crowd. That's about it for now. Stay warm, stay clean, stay away from other people, and we'll talk to you when there's more to say. Take care.